What does solid growth mean for my 2022?
Yeah, thanks. Good morning, Tom. Great to be here with you and everybody else. So solid growth to us means that growth is lower than where it was in 2021, but 2021 was a very high bar. That was extremely strong global growth. And 2022, we think, will still look pretty reasonable by the standards of the last 12 years, that we're still looking at, U.S. GDP growing around 4% this year. And even though we think we have a very disappointing first quarter in China, ultimately the full year growth we think will still be pretty reasonable, and that Chinese growth will reaccelerate as the year goes on. So when we're thinking about stagflation, I think we're thinking about a year much more like 2005, where PMIs are decelerating, inflation is higher, policy is tightening, than something where growth is really falling off right now in terms of what the market needs to deal with.
Andrew, the research you've put out recently is that we've priced in higher interest rates, but not the growth risks associated with it. Can you pour through the equity market for us and help us understand where you think that needs to be priced a little bit more?
Yeah, so I think this is where some of the debate around the yield curve, which I'm sure is something we are now going to be talking about for the next 6 months, is really interesting, because I think what the yield curve is discounting is higher odds of a growth slowdown next year, which we think is correct, and that certain asset classes are going to be more vulnerable to that than others. So, when we think about the overall equity market, when the yield curve inverts, it doesn't necessarily go down. In fact, it tends to keep rising after that inversion happens. The equity market's balancing. Yes, there's some greater risk of recession, but there's also a possibility that things continue on for another 12, 18, 24 months. But assets that tend to be more growth sensitive, something like U.S. high yield, that tends to see a pretty bad risk reward when the curve inverts, when the odds of a recession are rising, and that starts to really underperform after yield curve inversion. So we think that favors somewhat more defensive positioning within U.S. equities, things like healthcare, utilities. We think that favors investment grade over high yield within U.S. credit, and then some of the non-U.S. developed markets we think could be in a better place, a marginally better place, because the financial conditions there are easier. Policy is under less pressure to tighten in Europe and Japan.
Andrew, I find the banks call fascinating at the moment. Betsy Graseck made a move earlier this week. Can you walk me through how you and the team are thinking about the financials?
Yeah, so we downgraded financials from overweight, which had been a favored sector for a while, down to equal weight, and the reason for that is a function of both. We've had a very large interest rate move that had helped the sector, but also financials, as you start to get later in the cycle, have to balance both loan growth that is often still strong. Banks continue to lend even after the yield curve flattens, with the market often thinking, well, if the odds of a recession are rising, we need to price in a higher risk premium around higher loan losses, 18, 24 months out. So, we think the sector's risk reward is now a lot more balanced here, again, as those two factors are competing against each other, and after we've had a pretty large rate move. And so that leaves us more balanced and looking to reassess.
Andrew, where do long bonds sit in your portfolio, given the sell-off that we've seen to date, and given the call that you have that we're in the same kind of environment longer term, even given this blip?
So I think that the backdrop favors a flatter and more inverted curve. That's very much the way that our interest rate strategists at Morgan Stanley are thinking about that, and that we could even have a dynamic where the 2-year rate continues to go up towards 3%, but the 30-year bond does not rise in yield from here. Maybe it even declines a couple of basis points. Again, as the market is looking at a very strong, we think, structural demand for longer-term duration, and also as overall yields rise, the funding position of pension funds gets better. That increases the desire to buy long-duration assets to defease those pension liabilities. So we think longer-term investment-grade bonds offer better value here than, say, high yield. We think some parts of the emerging market credit index will offer better value than, say, emerging market equities here, again, in part thanks to the longer duration of that index. And we certainly would put ourselves in the curve flattening, long end outperforming camp.
Andrew, I know you've been building cash. I know that Morgan Stanley's approach generally has been to hold a bigger portfolio of liquid assets. At what point, what signals are you looking for to shift that, to deploy more and to go more into risk?
Yeah, it's a great question. So one, I mean, the equity market has clearly rallied back very, very quickly, and more quickly than we expected. So certainly lower prices, but more specifically, a higher equity risk premium would be helpful. What we've seen is, on our measures, a real compression of the equity risk premium, a large richening of equities relative to bonds in a short period of time. I think more space opening up there would be helpful. I do think the investment case in Europe could be a lot cleaner if we saw somewhat more certainty around the direction of the conflict in Ukraine, and that could I think certainly improve the risk reward as we think about that market. But I do think at some level the die is cast. We do think we're in a later cycle environment. A flattening yield curve, low unemployment, tightening policy is a part of that, and I think that at a broad level is naturally going to constrain how much risk we think investors should take, kind of regardless of these other factors. So, we think this later cycle environment is often one where one wants to be closer to home in their portfolio allocation, but, we would be looking for greater risk premiums to emerge in equities credit that we think would compensate for those risks before redeploying cash.
Andrew, just quickly, how's London? How are things right now? Because when I call family, they talk to me about how much everything costs at the moment. They tell me house prices are through the roof. What are you experiencing in the general economy there? What does Europe actually look like from your experience in the UK at the moment?
So, what we talk a lot about stagflation. I think the stagflation story varies a lot where you talk about it, right? You have very low inflation in Japan. You actually have quite good growth still in the U.S. I think the UK is closest to that stagflationary outcome. Growth here is weak and make it weaker as you see very large cost of living increases bite, even starting next month as utility bills rise. At the same time that inflation is still very high and where the current account deficit is still large. And so I think the Bank of England has a real challenge to it. I think on a structural basis, we are thinking that the pound will weaken against the U.S. dollar, the Canadian dollar. And, I think the U.K. does face a tougher macroeconomic backdrop than the European Union or the U.S.